Good afternoon, everyone. Welcome to this TradeStation webinar. Thank you for taking time out of your schedules to be here to learn a little bit about futures options. And today we are privileged to have Craig Bewick from the CME and Jim Iuorio from TJM Institutional Services. Both of them are our guest speakers today, and we're glad to have them here today. They're going to talk to us about risk management tactics of professional futures options traders. First of all, Craig and Jim, welcome to this webinar. Thank you for taking time and being here.
Thank you for having us.
Thank you. Yes.
For those that don't know me, my name is Jesus Nava. I'm in the education team for TradeStation Securities. It's always great to be here with all of you. Keep in mind that every symbol and idea that we talk about here is for educational purposes only. Trading online has its risks, and if anybody wants to learn about them, you can go to tradestation.com/important-information. Also, Craig and Jim are not affiliated with TradeStation. Craig is from CME and Jim is from TJM Institutional Services. Just keep those items in mind, but it's great to have them here. It's a privilege to learn a little bit about their expertise in the futures and futures options markets. So I am going to go ahead and mute my microphone, pass the microphone over to them. And Jim, Craig, the floor is all yours. Thank you for being here.
Awesome. Thank you, Zeus. And it's always awesome to be doing these webinars with TradeStation, with Jim Iuorio. And I'm particularly excited lately because for years I've been working with TradeStation doing webinars on futures. And it's only more recently that we've put an emphasis on futures options. And I think there's so much opportunity in futures options. It excites me that TradeStation wants to do this, that you're committed to options on futures. And this particular webinar, I think, is about as technical as I've ever gotten with Jim in terms of like real risk management and how do options really work, not just what they are. And I think it's important, obviously, to know what they are. And it's important to know what the difference between an option on a future and an option on a stock is. But now we're going to get really into how do options move? And particularly, we're going to compare a short-dated option, an option with 0 or 1 or 2 days to expiration, to an option that has a longer expiration because they act very differently from one another. So I'm excited to get into this. And again, I appreciate you having us. Thanks to Jim. I always say this, it's always fun to work with Jim. I always wind up learning something myself. And of course, thanks to everyone who's joined us today. I like to say it's certainly not lost on us that everyone has busy lives. And we recognize that you've chosen to spend part of your day listening to what we have to say. A sincere thank you from CME Group. And with that, I'm going to turn it over to Jim for 30 seconds. He can introduce himself and give us a short background while I share my screen.
First of all, to be asked to talk about options is like a dream come true because most people in most social circles, when you start talking about options, a lot of people fall asleep, but not in this group. I think we're all options geeks, and I love that. I started 38 years ago with Goldman Sachs right out of school, the University of Illinois, economics degree. I started with Goldman Sachs and pretty much right away was thrown into currency markets, currency options, then it went to interest rates. And throughout my career, it's been rates, currencies, equity indexes, commodities, 38 years of doing this. And again, a lot of people I know are new to trading options. I think trading options are fun and are great. And it's like solving a puzzle, but there is some risks involved. And I love doing a show like this that talks to people about the risk. We say all the time, there are old traders and there are bold traders, but there are very few old, bold traders. And what that means is that you have to understand risk, control risk as your number one priority if you want to stay in this a long time. And I hope you all do.
Perfect.
Awesome.
You both have access to the chat, and because the chat is open and anybody can send in questions, and it'd be great if you can take those questions live or you can wait until the very end to take them. That's totally fine.
Yeah, and if you're going to be on, Jesus, feel free to jump in because it's a little bit harder to monitor it while we're presenting. So if you do see something that warrants you jumping, it's certainly not going to ruin our flow. Jim and I have worked together a lot. And yeah, what flow? Feel free to jump in because I do think if there are questions, this is a technical presentation. So I think it makes even particularly more sense if you see something that we didn't explain very well and someone's got a question on, feel free to jump in. You have absolutely no issue with that.
We'll do. Thank you for that.
Yeah, and we're lucky to have Jim because Jesus introduced this as how do professional options traders manage risk, and Jim is a professional options trader. And in fact, I would posit that Jim is even currently brokering probably the most complex option that exists on an exchange-traded platform, maybe anywhere in the world, in short-term interest rate options. And we're not going to get into those because it's more of an institutional product. But no, that's what Jim even currently is doing for partly what Jim is doing for a living. So we're lucky to have him here with us, and it should be fun. The last thing I'm going to point out, and I know Jim is going to start to think I sound like a broken record when I say this. He introduced himself with part of his professional career, but if he looks familiar, it's because he's been on most of the financial news networks hundreds or thousands of times. And if you've ever seen him with Larry Kudlow, you would know that Jim is also the restaurant king of Chicago. And I always feel remiss not to introduce him as such when we're doing these things.
Greatly appreciated. Thank you, Craig.
Of course. So let's get into this. We've got a disclaimer as well. I'm not going to read it word for word, but while it's up for a few seconds, I would encourage everyone to check out CME Group's educational portal. It's called CME Group Institute. It has content out there from what I would consider 101 level stuff if you're just getting into futures and options, up to what I would say is graduate level work in futures and futures options. So check it out, whether you're just starting and you've been doing it forever. There's no such thing as knowing too much. So I think it's a great resource for people, CME Group Institute. And with that, let's move on. A lot of what we're going to talk about today is the option Greeks, but particularly we're going to talk about the Greek that's called gamma. And if you're not familiar with what options Greeks are, they're measures, when you look at an option model, they're measures of movement in different factors that's going to affect the value of an option. I'm going to go over the kind of all of the Greeks here at a higher level in just a second, but we're going to focus today on gamma because I think that's a very important, they're all important, but gamma is one that I think is very important because I think a lot of people know, for example, delta, and it's more intuitive. Gamma mathematically is the second derivative. And it's very crucial when you're trading options, particularly these short-dated options where gamma really impacts the value of an option, to understand what it is and understand how it works. So that's what we're going to focus on. We're going to look at the Greeks. We're going to use the Greeks, and we're going to actually look at a real-life situation that happened a couple weeks ago. We basically just tracked the life of an option throughout one day, and we're going to look at how both a long-dated and a short-dated option moved and why they move like that. And I'm going to allow Jim to jump in whenever you want, because you're an expert on this stuff. Like I told Jesus, jump in whenever you want. I'm going to invite you in and fairly often as well.
No, and I will say this is that if you're looking at this and you think it's complicated, it's not. You know how when you go to a lawyer, sometimes they use a lot of this legal speak and sometimes it's confuse you. Maybe it's designed to confuse you. And many options traders I know who've been doing this for a long time, they speak in platitudes and say words that sound confusing, but they're not. And gamma is not confusing. I like the fact that Craig already mentioned delta. Delta's intuitive. Delta's just the way an asset moves, an option moves compared to the underlying. And delta, just a simple way to remember, it usually at the money calls and puts are around a 50 delta, depending, of course, on their length. But gamma is something much more interesting. Should I go into it already, Craig, or no?
No, let me jump in here, but I do appreciate you saying that because I know sometimes it can be intimidating to look at this.
And it's not that complicated. If I can understand it, you guys can. Yeah,
that's exactly right. So let's jump into it. So delta, like Jim just said, delta measures an option price, or in other words, the value of an option based on how much the underlying moves. So Jim just mentioned that what we call an at-the-money option has a delta, usually a delta of around 50. And what that means is that if the underlying future in this case moves by 1 point, then you can expect that option, again, all else equal, and we're going to get into that because options don't occur in a vacuum, they're dynamic, but all else equal, if the underlying moves by 1 and it's a delta of 50, which mathematically would look like 0.5, then that option value would be expected to move by 0.5. If the delta was out, what we call out of the money, and let's say it was a 0.25 or a 25 delta, and the underlying moved by 1, then you would expect that the value of that option to move by 1/4 of a point. Now that's the sort of mathematical definition of delta. I also like to point out that there's a couple of, I don't want to call them anecdotal because it's a little bit stronger than that. Maybe you have a better word for it, Jim. But a lot of people look at delta as a proxy for one, what the probability of that option winding up in the money is. And that makes intuitive sense, right? Because a 50 delta is going to be right at the money. So there's a 50-50 chance that that underlying is going to go up or down. So a 50-50 chance that option is going to wind up in or out of the money. Now, that's not a mathematical formula, and it's not hard and fast. but it's one way that people look at what delta means. And I think looking at it like that makes it easier to understand kind of what delta means. And the other thing that people use delta for is the number of, in this case, futures equivalents that they have on. So if you have like an option that's a 50 delta on, you might look at that as saying, I've got half of a future on. You might hear a lot of futures and options traders say, I've got 100 deltas or I've got 75 deltas on. What that means is how many futures equivalents they have on incorporating their options in the position. Does that make sense, Jim?
No, I think that makes perfect sense. And by the way, I like what you just said about the 50-50 thing. And honestly, I've never really thought of it that way, but that is an interesting way to think of it. That there's also something I'd add too, because in stocks trend higher. They're one of the few asset classes that do. They mathematically trend higher because every company within the S&P 500 is constantly shedding unperforming sectors and assets and replacing them with ones that are performing. Other things like gold and foreign currencies, they are completely equal in two different ways. So something at the money, if you say over any given period of time, you flipped a coin in stocks and say in a week, in 2 weeks, in 3 weeks, is the market going to be higher or lower? Statistically, there's a slight advantage to it being higher because it tends to trend from lower left to upper right. But other things that aren't structured like the stock market have more of a 50-50 shot. Now, I'll say that in things like gold and in oil, you ask yourself, where does disaster exist? And in gold, if something crazy happens on this world, people will flock to gold. So we'll go higher. The demand for gold will increase. So calls should be priced slightly higher than puts in a vacuum. Same in crude, because supply shocks can happen in crude. So calls should be priced slightly higher. Now, puts is where the disaster exists in stocks. So starting to get out of the money puts, sometimes they are priced higher, even though the stock market tends to trend higher. I'm sorry if I went on a tangent there, but I think these things are fascinating.
Not at all. And I appreciate it. And what Jim's referring to is if you're an options expert, he's referring to call put skew, right? Where you'll see traders price out of the money options differently depending on their essentially what the market view of what's going to happen is. And I think it's very interesting, Jim.
What could happen, right? Yes.
What could happen, right? And in WTI crude, you might have a put skew or you might have a call skew, depending on what the supply demand situation is, like economic conditions, geopolitical factors. The market may price in more of a downside risk than an upside risk, depending on what's going on. So it's very fascinating. And I'm glad you pointed that out. So the last thing I want to mention on Delta is that a lot of professional traders, market maker types and things like that, will tend to try to trade delta neutral. So in other words, they don't necessarily want a directional bias in their trading. They're strictly trading volatility such that, and I'm going to oversimplify this, but such that, let's say they bought 100 calls that were 25 delta calls. So they bought 100 out of the money, 25 delta calls. They may hedge that by selling 25 futures. In our case, I'm only going to speak in futures as the underlying here. So they might sell 25 futures. And in that case, at that moment, they're essentially what they would consider delta neutral, where they're not going to be subject to a P&L impact on the underlying movement. However, that's what brings us to gamma. And it's because of what I said earlier, which is none of this is static. It's all dynamic. So even though at that moment they're what we call delta neutral, gamma is a measure of how much the delta is going to change based on the price of the future move. So if you consider delta kind of the first derivative, where it's a measure of how much the option value is going to move based on the future, gamma mathematically is that second derivative, or the velocity of how much delta is going to move when that futures moves, which means that in the case I just gave you, if that future that they bought, the 25 futures they bought, now that future rallies, the gamma is going to make that delta change, and all of a sudden they're not going to be delta neutral anymore. That's what gamma essentially measures, is how much the delta moves based on the price of the future. And that really comes into play when we start talking about short-dated options. Anything to add there, Jim? Because I want to lay a good foundational base here.
Sure. And just to add to that foundation, because you guys ask yourself, Craig gave an example of you buy 100 calls that have a 25 delta and you sell 25 of the underlying against it. Why would a market maker do that? Let's say he had value of that option at 5.5, but because a big seller was coming in, they say, I'll pay 5 for it. So they're buying the option slightly incrementally lower than where they think it should be priced based on their model. And then they hedge it delta neutral. Their hope is everything to stay the same. Well, one of their hopes, everything to stay the same. And just to make that quarter or half tick that they got into the option. But that does then lay the foundation for the good gamma discussion that we're going to have.
Great, thanks. So let's get into theta, which measures how sensitive the value of an option is relative to time. So let's say you're long options because you've bought options, which gives you obviously, we don't know, that gives you the option to buy or sell something at some time in the future. Just intuitively, or to give you an option, give you a long option, would you rather have an option that had 1 day or an option that had 75 days? I think most people would say I'd rather have one that has 75 days because it's much more likely that the price is going to move for me in 75 days than it would in 1 day. And that's kind of how I think, the very simple way that I think of theta is simply because you have this option, what's more valuable, one that has no days or one that has a lot of days? Now, what that also means is that option that has, let's say, 75 days until it expires is going to be less sensitive when the clock moves from 75 days to 74 days. That's going to impact the value of that option much less than an option that has 2 days and it moves to 1 day. So when you're long options, we say you have a negative theta because that time decay works against you. So when you're long option, that time decay works against you a lot more when it's a very short dated option versus a long day option. I'm going to stop there and let Jim clarify anything that I may have butchered.
And I like that quite a bit. Generally speaking, you'd rather be short theta making money on time decay, but that's not always the case. Sometimes you put on a trade that you think something's going to happen relatively quickly. But no matter what your directional bias is, you can always use options to shape it to be either long or short delta. I like long or short theta. I like to be short theta because I like, again, if a trade, like if you want to be long something, an example of being short theta would be to sell a put to be long that, and then that put keeps going down. Other people buy a call, that's being long theta. Now, selling the put obviously creates quite a bit of gamma risk, but not if you sell a put spread. You can define that. So you can always kind of define something to make theta work for you if you know what you're doing. And I think it's a really interesting puzzle to solve.
And I think you just mentioned something that's key about options trading in general, which is you can construct these packages such that you can define how much you can make or lose even before you execute the trades. The spread that Jim's just talked about, if a put spread, you can define your max loss on that trade even prior to executing it, which I think is a really cool feature of options. Or you can have unlimited risk options depending on your risk appetite and your view of what's happening. So I think that's also a good point. Vega is a measure of how much the implied volatility is going to affect the value of your option, or a change in implied volatility is going to affect the value of your option. And just to, in case we have people that don't know exactly what implied volatility is, it may be the most important thing that you need to know when you're trading options, because it affects the value of an option. Because we know everything else that goes into what makes an option have value. We know the strike price, we know the underlying price, we know how many days until it expires, we know what the interest rate is. What we don't know is how much the future is going to move between the time you buy that option or sell that option and it expires. That's what implied volatility is. So it's essentially the market consensus, the option market consensus of how much the futures price is going to move between the time of execution and the time that option expires. And all else equal, the higher the implied volatility, the higher the value of that option. The lower the implied volatility, the lower the value of that option. And the way I think of it best, and the best way to explain it, is if you were looking at one of these stocks that moves around a lot, and I'm going to go into stocks just for 1 second because it's intuitive, but let's say Tesla. Tesla moves. Let's actually not use Tesla. Let's use something like NVIDIA or Apple, which moves, but not with the volatility that Tesla does. If NVIDIA has 2 months until it's going to report earnings, or if NVIDIA has earnings coming out tomorrow, which option, if you were selling it, would you require more for in terms of implied volatility? I didn't say that very well, but essentially most people would say, if I know this company that in a lot of ways is a barometer of the technology economy right now, has earnings out tomorrow and these earnings have the potential to move the stock. I'm going to require that someone pay me more money for that option than one option that expires before those earnings come out, because I'm obligated, if that stock moves a lot, to take the other side of that. Jim, I didn't explain that very well. Maybe you have a better.
Sure. Yeah, no
to
worries at all.
clarify.
Look at something like a Bitcoin versus what's something that doesn't move a ton. Let's say the euro,
Like a
the
euro
currency.
currency, right?
So if Bitcoin moves an average of, and I'm making this up, 5 to 10% each month up or down, and the euro moves 1% each month euro down on average, looking back at all the charts, if you're buying a call that's 5% above the market in Bitcoin versus 5% above the market in the euro it's not as likely to hit, whereas the Bitcoin is, because it moves crazy like that. I like what you said about the earnings part of it, is because, and remember the other side of the equation, the reason the price of that the day after earnings of Apple, I think was what we use, is all jacked up, is because people who buy options, most people are buying options and most people aren't selling them, are buying a lot of options for that eventuality of that binary event of the earnings release. So it stands to reason that gets built up because there's risk involved being selling it.
Exactly right. So what Vega does is it says how much the value of an option is going to change based on a change in the implied volatility. And in terms of what has more Vega, an option close to expiration or an option that's far from expiration, it's the reverse of theta, where if an option has a lot of days until it expires, let's say 75 days till it expires, it's going to have more Vega, because if you have a heightened volatility with 75 days left, that's a lot of time for that underlying future to move. Whereas if you have an option that only has 3 hours until it expires and you have a change in implied volatility, there's not as much time for that heightened implied volatility to really affect the value of that option.
And we're probably seeing that right now because the Fed, for people watching it live, because the Fed just came out. So let's picture it this way, is that a binary event. Today was the Fed. So you had options on and interest rates that were bid up because they could go either way if the Fed throws us a curveball. So the Fed doesn't throw us a curveball. And all of a sudden, the price of the asset may stay exactly where it was before the Fed, but now that event risk is gone. So the price of that option starts dwindling despite the fact that there's no discernible movement in the price. That's Vega. That's because you were pricing in an event. That event is gone and there's more certainty left. So implied volatility is being drawn out. So the price is going down because of it.
Very good. And so the final one, these are all important, but if I had to rank them, I would probably put what we call ROE, or the interest rate sensitivity of options, probably the lowest on the list of the Greeks, because what ROE does is it measures how much a change in the risk-free interest rate is going to have on the value of an option. And that goes into the way that options are bought and paid for, and the fact that when you buy an option, you pay for it, but you don't have to pay as much as if you were going to buy the underlying of that. So all of that time value of money has to be taken into consideration. We know there's no free lunches in finance. So that time value of money has to be taken into consideration, and it's what we call ROE. So if for whatever reason we had a huge spike in the risk-free interest rate, then the value of an option, depending on whether it's put or call, actually could go up or down, but it's probably the least impactful of all of these Greeks that we've just gone over. Would you agree with that, Jim?
I agree completely. I'll talk about it and pretend it's important, but if you're going to tune out in any part of this discussion, tune out right now, because there's two sides of it as well. Is that one, just today, I sold indexes that I was long and replaced them with calls just because there was other things I wanted to do with that margin money when the risk-free rate is 4.5%. I don't know that I didn't really put it into 3-month bills or anything, but the motivation was there to do other things in a higher risk environment. However, market makers tend to be more aggressive selling because then they take the money they sell from it and invest that overnight at a higher rate too. So the bigger effect is making prices go higher because people replace long positions with options or short positions with options. But there's also something that counters that on the market maker side as well. But anyway, wake back up. Now we're going to start talking about
Very good. So let's look at how some of these Greeks, as we call them, act versus the days until an option expires. So we talked about how, and we're going to get into, like I said before, we're going to get into a real life example of this. And this, by the way, is a real life example. So I used CME's actual trading front end. We call it CME Direct. And I basically looked at the E-mini S&P options. and I just picked random days until expiration, starting from that same day option, or and Jim knows I don't love the term, but the 0 day, the 0 DTE option, all the way out to 75 days. And you can see it looks like there's a bit of a kink in the curve there. That's because like the number of days to expiration, like it's just a scaling thing. I was using a 1 day and then it jumped from 29 to 35. So it has a little bit of a kink, but that curve is actually pretty smooth. So what it does is it says, an option with 0 days, so a same day option, is going to have a lot of gamma. And that's the left side of that x-axis, right? The 0 day is all the way to the left. And you can see it by far has the highest gamma, which means small changes in the future are going to have a relatively much bigger impact to the delta of an option than an option that has 75 days. If you look far to the right, so that was the last day that I graphed here, has very little gamma. And the reason I brought up the whole idea of delta being the probability of winding up in the money was because I think it makes it intuitive to explain this, where if you've got 3 hours until, or 4 hours till an option expires, and the future moves, let's say the S&P moves by 5 or 10 points, that's going to have a much bigger impact on that option winding up in the money when it expires in 3 or 4 hours than a 5 or 10 point move in an option that has 75 days until it expires. So that 50 delta, if we're talking about at the money options, is going to change much more on an underlying move on a short dated option than it would on an option that has 75 days left, where kind of like anything could happen. Jim, I'm going to stop there and let you clarify. Maybe you have a different way to say that.
No, and I know I really like it. And by the way, I always tell younger options traders is that you can learn gamma, but the moment you're caught in a serious gamma squeeze is when you're like, oh yeah, that's what gamma is. Once you feel the pain. But I will explain it this way.
Yeah.
Let's say you're trading a CME option that is expiring that day, and you sell a call that's 1 full percentage point out of the money, and you think, okay, but let's say it's a 30 delta, and maybe even you have a hedge it, maybe you don't. For our explanation, it doesn't really matter. But as the market starts to get close, okay, you start to sweat a little bit. Let's say you have on that call and it's gaining delta. All of a sudden, as time and price start to converge, like the clock is running out where the expiration is approaching, all of a sudden it goes through the strike price. With every tick, increases your motivation to buy it because it's your pain tolerance. So all of a sudden that delta starts to gain, that option starts to gain delta through the gamma squeeze. And then all of a sudden it's 5% above where you sold it. And you're like, crap, I got to get out of it now. So then it exaggerates the move because all the people who may have been short those calls are starting to cover because they can take no more pain. So that's oftentimes a real good gamma squeeze in either direction. Oftentimes can take a big stock market move and make it into a really big stock market move. So that's why you always have to look at where open interest is on a lot of these products. And again, I always talk about how in interest rates, the options are usually written on at the psychological levels, 4.5% in the 10-year, 4%. That's because people put them on months in advance. And if you're targeting rates to go higher, you don't target them to go to 4.48. You target them to go to 4.5 because it's just a big round number and it's easier for accounting purposes. But once it starts to move through that, all of a sudden your calls, I'm flipping it around like it's yield into it. But all of a sudden you're like, oh no, I have to cover. So boom, you have to cover. And that's, my friends, is a gamma squeeze. And it is not pleasant. Yeah,
exactly. And I love that explanation, Jim, because when you've sold the call that you mentioned, you're what we call short gamma. That gamma starts working against you as the position moves against you in an amplified way, because what was a 50 delta, right, or what we say 30 delta. So essentially that option value in theory is going to move against you by 0.3 on the first move, but now the delta is higher. So that next move is going to move against you by 0.4. And then on a move higher, now all of a sudden you've got a 60 delta. So every move gets amplified, that's part of the 0 DTE, and I'm going to use the term now, but that's part of the 0 DTE trade, is that they're high gamma trades, a high, what we call optionality, and it can work for you or against you.
Yeah. And again, if you're new to this, I would suggest being a buyer of gamma, being a buyer of options until you 100% understand what your risks are. Because the last thing you ever want to do is all of a sudden wipe out your account and say, oh, now I get what these guys are saying. Because it is something that is a rhythm that you need to know. And that, as you see, that chart moves exponentially. If you envisioned it from right to left, it moves exponentially higher, closer to zero. And to me, you can feel it, or you can look at it on a chart. I'd rather look at it on a chart.
Exactly. And I've left the gamma on in the lighter shaded line here. So that's the same graph that we just looked at. But I've overlaid theta on it, which now I'm going to counter what Jim just said, because on that 0 day where the gamma would be working against you on a short gamma position, short option position, the theta is actually going to work for you. So it's two counter forces acting against each other when you consider gamma versus theta, because if you've sold that option, now all of a sudden you're long theta. And as the time passes, that's going to work for you. So it's a combination of your gamma and your theta exposure, particularly again on these short dated options where, on the theta obviously is the opposite where, and it gets a little counterintuitive because zero's up on top there versus the negative theta on a long here. But on a longer dated option, you're going to have, like I explained before, a much smaller impact on your option value due to time decay on an option that has 75 days until expiration.
I think what's really interesting on the theta chart, by the way, too, is because the gamma one is a more mathematical exponential chart. It makes sense. The theta one, there's a psychological element of that too, where beyond 5 or 6 days, it seems like the market prices in a potential outcome that's way broader. And all of a sudden, it's almost like the market says at 5 days, oh, shoot, the clock's running out on this. We better get out of the decay is going to hasten. So it's really an interesting thing. Yes.
Totally. So now I've kept gamma on because again, we're having a discussion about gamma, and I've overlaid volatility on this one, or Vega. So how much the option is going to be impacted by a move in volatility. And as I said before, your Vega is going to be much higher on an option that has 75 days until it expires than it will be on a day that has 0 or even less than a full day till expiration. So again, that change in implied volatility is going to impact a longer dated option much more significantly than it's going to impact an option that's going to expire on that same day.
And I imagine the gold market would be a great example of this right now. And I'm not certain of this because I haven't checked it, but I'd certainly be confident enough to say it. I imagine that Vega implied volatility in gold options has gone up quite a bit because all of a sudden since September 1st, the trade has changed a lot. Gold rallied 30% in the matter of 2 months and then broke 10%. So my guess is that the options market now saying, okay, these possibilities for gold having wild swings in the future, the door's now been open to them. So we have to price in more implied volatility. But I always, like I said before, Vega, I like to look at what happens after a binary event because it seems like that's much of the options trading is around those binary events. And it's fascinating to me how Vega gets sucked out of the market right after that possibility goes.
Exactly. And I actually did look at gold while I was putting this together, and you're absolutely like the vol in gold has spiked with the parabolic move that we've seen in price. So,
and that's again, that doesn't uncover any sort of genius in me. That's an obvious one. That I would get.
It goes back to the explanation of implied volatility. If you're selling options on gold and you were selling them a year ago, or you're selling them today, which one would you charge more for?
You can charge.
I'd charge more today, right?
Yes, yeah.
I'd want to protect myself.
No doubt about that.
I put these on because I wanted just to show that an option, and this is one of the cool things about options, I think, is that an option is an option. And we're talking about options on futures today. You may be trading options on stocks. You may not be trading options. But what I love about options is it's all math. And so I did the exact same thing with CME's WTI crude oil options as I just did with the E-mini on the same day I did the E-mini. And look, they all look the same. Gamma works the same. Vega works the same. Theta works the same, which is, I think, one of the cool things because once options, it opens you up to being able to trade all these diverse asset classes that CME offers, like equities, interest rates, foreign currencies, crude oil like we have here, energies, metals like gold and silver. Once options, the math works very much the same way.
Yeah. And one thing that's interesting, you mentioned that I broker in, options in a very complicated product, but it wasn't until 20 years ago that I made the realization like, oh, I have amassed this knowledge on complicated options over the last 15 years. Once you open that door, you can make some money yourself on it. So I don't trade as much the interest rate products that I trade institutionally, but I think I trade options again are a passion for me.
Totally. And what we mean, and what I mean anyway, when I say Jim trades a very complicated options product, is that you'll find that what we call the SOFR options, which is short-term interest rate, tends to trade in very complex spreads. So where we might look at a lot of like call spreads and put spreads and butterflies and maybe like broken flies and condors, you'll see like multi-legged spreads going off in that particular product. And that's all we mean when we say that it's a complicated product.
Because these bond geeks think they can rework the mousetrap, which I love it, by the way. Yeah.
Exactly. Let's skip over that. I had the gamma curve based on whether you have, the gamma curve is different if you look at gamma across strikes, depending on whether you're in a high volatility or a low volatility environment. So the gamma curve tends to be a bell-shaped curve where the sort of body is at the money. And if we're in a low volatility environment, you see a very distinct, very narrow bell shape. Whereas if we're in a very high volatility environment, that bell gets flattened out. And I think that makes sense too when you go back to consider like that 50 delta. If you take it to the illogical extreme and you make implied volatility infinity, almost everything becomes 50 delta then. Because who knows where it's going to be. If, again, I'm speaking in like illogically a little bit, but if you make implied volatility a bazillion, then you don't know where it's going to be and everything becomes 50 delta and your gamma curve is very flat. Now that's an exaggeration, but that's why that gamma curve tends to flatten in lower volatility environments.
No, I like the way you described that too. And again, and remember, even look at the VIX or whatever the products are that measure volatility in the S&P. And the highest we've ever been is, call it 80. I think that was a couple of years back. But it mathematically can't go higher than pricing in 100% moves. You know what I mean? And so if there is a moment in
well,
time
never say never. We never say never on our
good point. Let's never say never, but there is zero on the S&Ps. So if you're hedging for it to go below zero, I'm just saying you might be wasting your money.
In theory,
the
but
crude did go negative. Crude went negative.
So we
don't
no
storage costs for S&Ps. So crude did go negative by $40.
But yeah, Jim's, and again, obviously I was speaking in illogical extremes, but I think just to prove the point or exacerbate the point, that's why you get on the gamma curve, the out of the money strikes versus the at the money. That tends to be a lot flatter in a higher volatility environment and more of a narrow bell in a lower volatility environment. So let's get into the actual example that I think really is going to drive all of this. I hope drives all of this home. And I did this manually. This was a very manual exercise I did, but just for sake of example, I looked at two real life E-mini S&P options. I think I have the date here on October 14th. So I started looking at these two options, one that was expiring that day. So it had about 5 hours left until it expired, and one that was expiring in 38 days from then. And like I said, I started looking at these options at 10 a.m., almost 10 a.m. in the morning, when the futures price of the S&P 500 was 6660 spot 5. At that time, the longer dated option had a call value of 148.20, and I think I was using the midpoint if there was a tick in between bid offer. The value of the call was 148.25. The put was 137.62, and then you can see the corresponding prices of the same day option. The call having about 16 and a half, or I'm sorry, 17 and a half, and the put being about 17. So those were my proxy for my at the money options. 2 minutes after I started looking at them, the futures price had moved up by 3 points. What happened to the 38-day option that had a gamma of 0.001? So a very small gamma value. The delta actually didn't even move. The price of the option went up just fractionally, and so on and so forth. On the shorter dated option, the delta actually moved up by 2, not a lot, but it wasn't a big price move, but the delta actually did move on that option. And the call value actually went up by more than it did on the longer dated option in percent terms, a lot more, even on a 3-point move. 4 minutes later, the price had changed by 5. So the price had moved up another 5 points. Looking at that longer dated option, the call went up by a little bit. Delta went up by just one. So it went from 52 to 53. And like I said, the price went up slightly. The shorter dated option, the price moved by more. That value of the call moved by more. Again, the gamma is 9 times as much, right? So where the gamma, and I should have mentioned this, the gamma on the longer day is 0.001. The gamma on the shorter day was 0.009. Now the gamma's moved from 51 to 58 in just 4 minutes. Or I'm sorry, the delta has moved from 51 to 58 in just 4 minutes and 8 ticks in the future. So you can see how much different that delta is moving, even with a relatively small move in the future. Now by 10:20, just 15 minutes later that day, we had the price fall by 9 ticks, 9.25 ticks. So now that call value is actually lower than it was when we started looking at it. The delta on the longer date is back to 52. The call value on the shorter dated is now lower by 1.5 points, more than 1.5 points. The gamma is actually bigger. We have less time until it expires. And the delta is now even below 50. So that delta moved from 58 to 49 just in that 15 minutes with a 9-point move. Then we had a half hour later, the price had moved by 25 points. So now we have a bigger move in the S&P future. The call value did what it did. You can see in the longer day, the delta moved up but just by 0.03. So it moved from 52 to 55 on the longer dated option. This is where it gets really interesting. And I think this is where it really drives the point home. On the shorter dated option, the value of that option went from 16 to 31, almost doubled with that 25-point move in the future. The gamma changed down a little bit, but look at that delta. The delta moved from about 50, 49, all the way to 73. And that's exactly what we mean when we talk about these short dated options and the gamma that they possess. I'm going to stop there, Jim, in case you want to just say something about that. But that's exactly what we're talking about when we talk about the optionality in these shorter dated options.
So the interesting thing that I see there is when the gamma went down, when it went up 25 ticks, and that's understandable because when the delta goes to 73, it's kind of the market is forgetting about the put. The call is trending towards 100. So once it's 97, ostensibly 100 on the next frame, then the gamma's only 2 because the delta has already changed to as high as it can change on the upside. Things could turn around the downside, but I think it's fascinating.
It's a great point, and one I should have mentioned, because now that 73 delta is no longer our at the money. We've got another option now that's our at the money here, that gamma, which probably has a bigger gamma, right? Like that, the new at the money after the price move probably has a bigger gamma, but our gamma, Jim just eloquently pointed out, has actually gone down, even on a short dated option, again, because of that gamma curve now with the strike. So that's a great
where the
point,
delta is,
Jim.
right? Yeah.
Then the price went up another 35. Now we essentially have 100 delta options. So now and again, this was a big price move. I don't think I planned it on this day. It was the day I was putting this deck together, and it worked out very well for me for illustrative purposes. We had a big price move. Now that delta has gone up almost to 100. The price of that option has almost doubled again. The value of that option has almost doubled again to 60 from 31, where if we look at that longer dated option, yeah, it's gone up, but certainly in percent terms, not nearly as much. And that delta has gone from 52 when we started just to 59. The delta on the first one's gone from 51 to 97. I think this is a great illustration of why these 0-day options, why that gamma can work for you or against you, depending on what side of the market you're on.
I think you covered it well. I think it was very easy to understand. Nice.
And this is just another way to look at it, just a simpler way to look at it, because instead of looking at that premium change in the option value, I listed out here the option value in percent changes. And you can see by the end of the day, that 0 DT option on the call had gone up by 185%, where on the longer date it had gone up by 15%. Right now, of course, if you're on the other side of that trade, that's a negative 185% for you and a negative 15%. So this can obviously, as with everything else, can work for you or against you. But that's that optionality again that we talk about with these 0 days.
Amen. Love it.
Let's talk gamma scalping a little bit, Jim. So how can you, if you've got this position on, how can you protect yourself? And this is the way we talked about at the onset. This is the way a lot of professional options traders basically make their living in some ways. So that delta neutral position that we talked about in the beginning, Jim, so why would someone put on that delta neutral? Well, they got a price edge, a perceived price edge based on their option model that they wanted to buy those options. So let's say the same exact option that we bought. Now we've got to buy 100 options in order to be able to do this because you can't do fractional futures. So let's say we did the same two options that we looked at 958. We bought 100 of the 38-day options. We bought 100 of the 0 DTE days that had the respective deltas. So to get neutral, to get quote delta neutral, you would sell 52 on the longer dated and you would sell 51 on the shorter dated, and that makes you that delta neutral that we talked about. What happens is because of gamma that we've been talking about, that delta changes. So in order to stay delta neutral, you either have to buy or sell futures as that price changes to remain delta neutral. So if your delta goes from 51 to 53, you've got to sell 2 more futures against that options position to maintain that delta neutral exposure. So on and so forth. If you look at the way the delta moved, here's what would have happened. And I want to point out, this is a very academic exercise that I did here, because in reality, a professional trader would be doing this as the price moved, not just at these chunks of time that I did it at. So this was just to illustrate how like gamma scalping would work. So you would sell 51, sell 2, sell 5, then you'd buy 9 back. Remember the future price moved the other way. So you buy 9 back, sell 24, and then at the end when the option expired, you'd buy the 97 futures back. And if you did all of that at the prices that we were looking at, you'd see on that 0 DT, you'd come up with an overall P&L, excluding fees, commissions, and everything else, of a positive around $500. And on the longer dated, it was actually negative. And that's because in order for gamma scalping to work, the price has to be moving around enough, that delta has to be moving around enough to make up for it. Jim, that was my 30-second explanation. Tell me what I missed.
I don't think you missed anything. So the hope is that as you are hedging your options, that the market moves back, hedging your options with futures. As you said, you had to sell 5 more to make you have 55. I don't know exactly what you said. So now you're short 55. All of a sudden, the market moves the other way, and the delta, the natural hedge would be 45. You buy them back. You're buying back those futures at a normal price. Your sincerest hope is that it bounces within a range, and you keep doing that, and you're padding that side of the trade, which is the futures part of it, making money as you sell them and buy them. And by the way, it can work the other way too. Sometimes
Correct.
It goes through you, and you have to keep selling out, and then all of a sudden you're like, oh no. But I think you did it perfectly.
Great. But I'm glad that you said it the way you did, because what you're hoping for is that movement allows you to buy here, sell it here, buy it here.
And it often does.
Markets
don't move in one direction all the time. It often does with so many participants. So a lot of times, like you said, many market makers, this is their bread and butter, is to scalp gamma.
In a way where you're not absolutely directionally long, where you're going to get absolutely your face ripped off on a rip, right? So that's the idea behind this gamma scalping, is that you stay fairly market neutral and you can make money on those shorter term situations in price.
That's the hope.
Again, this is a very academic way to do it, because I use these chunky time periods, and I just said, assuming you can get these trades off at these prices and stuff like that. If you were doing this in real life, you would be doing it more consistently throughout the day as the delta moved, not waiting for like these bigger delta moves to do it. So I just wanted to illustrate kind of how it works, but not necessarily a real life situation.
And the delta moves a lot more, like you said, in a closer to expiration option. So it gives a lot more opportunity for it.
Exactly. That's what I had today, Jim. One thing I want you to do, you said gamma squeeze and you explained it. What exactly is a gamma squeeze?
So let's say that you look and there's a tremendous amount of option open interest, particularly on the call side. That's 0.5% above the market in the S&P. We'll get into that day. And all of a sudden, market starts to move, market starts to head higher. At first, all the people who are short the calls, they're maybe scrambling a little bit to cover their deltas because they're getting a little bit more exposure. But then all of a sudden it gets to at the money. We've seen that gamma curve. It moves exponentially. Now, the exponential part of it is the key to the ferocity of which this tends to happen. So now all of a sudden at the same time, let's say there's just 3 hours left in an option and a call you're short, or the world is short, and it starts moving through that that the price where all the calls are written at. So goes from at the money to in the money. All of a sudden, everybody who's short that call, they don't want risk is the biggest thing to understand and to control. They all of a sudden are at a tremendous risk. So they start buying back deltas, meaning buying back as the delta goes higher, they start buying more and more futures. So every one of those traders that are short those starts buying at the same time. And oftentimes a gamma squeeze can turn a simple 0.5% move in the S&Ps or any other where options are heavily traded into these 2% big, huge daily moves. Now, there's one last thing I'd like to add is that there's been a tremendous amount proliferation of short dated options that people trade now. I bet it's gone up 100-fold just in the last 10 years, maybe even more than that. One thing I think that it has the ability to create volatility in shorter time frames. Excuse me one second. When you talk all day, sometimes you get hitches. But anyway, so it has the capability of creating more volatility in a daily basis, 2-day basis, a week. I actually think it's not a bad thing for the overall structure and volatility of the market longer term. Because oftentimes big bear markets and big corrective phases, painful ones, are born of lack of respect for risk. I don't mind the fact that traders are reminded of risk almost on a daily basis when we're looking at so much open interest in these 0 days to expiration. And I'm not usually a find the silver lining kind of guy. Your bond people are normally negative. So it took me a lot of questioning myself to come up with the thesis that I think it makes for a more durable market, if that's interesting to anybody.
Sure. And I think that neither you nor I are here to say you should or should not trade 0DTEs. And if you have traded them, I think you intuitively realize how much the price can change quickly on that particular day with relatively small moves in the underlying. I think that's in your face if you've tried it. But we're here to say, hopefully this helped point out why that happens and why it tends to move more quickly than a longer dated option. And just understand that can work for you and it can work against you.
No doubt about it. Again, if you're new to it, trade small, think about risk, own options instead of being short options. I think, again, I'm not telling you what to do, but discretion is the better part of valor, and mitigating risk is the one thing that all long-term traders are good at.
So that's what we had. Again, I want to thank everyone for being here. I think Jim and I have a few minutes if there are any questions. Zeus, I'm going to stop sharing just for a second here.
Sure.
And
there were no questions in the chat all this time, so that's why I kept quiet.
No worries. So
does that mean we confused the heck out of everybody that they can't even fashion a question?
I mean, one of two things. One, it was too clear, or the other one is just that
too clean or not clean enough. Way enough.
Thank you very much, Jesus, and thanks to TradeStation. Of course, thanks to Jim. I thought this was fun. This was different than a lot of the ones we've done in the past.
Love it.
And hopefully, here we go. We got one here.
Yes, we did.
I don't exactly understand it. Oh, it's gone now. I don't see it anymore. What did it say?
How the futures
are
hedging the options.
Every option has a delta, which is how many futures underneath it's supposed to move. Like Craig said earlier, you can figure out what the delta is and the CME direct, and then, or you can run your own models, and then you have to do if you want to hedge it, you do the amount of options. Let's say you're long 100 calls, 30 delta, then you have to sell 30 futures underneath it, which, by the way, it's very different in cash equities. Each one option equals 100 shares. So there's very different. In futures, one option equals one of the underlying because it's such an already heavily levered instrument. But that's basically how delta works.
Exactly. And that's why in the example we looked at the very end, we had to essentially simulate buying 100 options in order to be able to do essentially the delta equivalent in terms of futures.
And I think that's what Michael was interested in, is the 1-to-1 instead of the 100-to-1 in cash equities, I think. Yeah.
Yep. And there's a question here, Jesus, about how to trade on CME Group, and that's through TradeStation. And if you've got a futures enabled account, and I'm going to stop there and let you go take it from there.
Yeah, it's TradeStation's show. How do you think we're going to tell you?
For sure. Yeah. Just make sure you reach out to one of our team representatives, and they'll go over the details on how to open up an account, how to fund it, and how to get access to all the CME products, of course. Yeah.
And it's worth pointing out that CME also has options on its micro-sized products. And like Jim said, if you're just getting into this, trade small. Micros give you an opportunity to do that. And then the options on the micros, because it's a fraction of a future, unless you're trading a very, very big option, tends to be even smaller, right? So just for example, the micro S&P that we were looking at, the mini S&P, we also have options on the micro S&P that allow you to trade options 1/10 the size of those mini.
Yeah. And one thing to keep in mind is that if you're going to be talking to one of our reps, just be specific about which type of or futures account you want to open. Because if you want to trade options on futures, you do need a very specific type of account at TradeStation. So if that's your intention to trade options and futures, make sure that you say that if you're talking to one of our reps.
Okay.
Very
Recommendations.
good.
Yes, I'm not
I
sure
don't, we
about
don't
that
make
last question.
recommendations, Michael.
Yeah.
I say that I think there are I know plenty of people who make daily gains and are good as day trader. I've always said myself, I'm not the world's greatest day trader. I trade every day. I find it very difficult, but I like to plug into the markets. Where I actually make the glut of my money trading is 3-week time periods, swing trading. So the question, do we recommend futures trading for daily gains? I have to say no. I recommend being very plugged into markets and being an active money manager. And I know that with practice and with persistence, you can get good at it. Does that satisfy?
Good. Seems so.
All right.
Cut off my mic there for a second.
Cut
Craig.
him off before he makes a wreck.
Yes, Craig and Jim, thank you so much for your time. This was very enlightening. Thank you for your time. Hope we can do this soon again. I'll reach out to you later about that. But thank you everyone who also attended this class. I know that it's not easy to take time away from a regular schedule to sit down through a webinar. The webinar was recorded, so we have a way of reviewing the information. We'll have it ready on tradestation.com soon. If you have any questions about content or how to get hold of these guys, just email education@tradestation.com. I'm putting that email address right there in the chat. And just reach out if you need a link to the webinar if you cannot find it on YouTube or the TradeStation website. Craig, Jim, again, thank you so much for your time. Have a wonderful afternoon, everyone. And I hope to see you in a future event. Goodbye, everyone.
Thank you, guys.
Thanks very much.